Under the surface, today's market reaction revealed a significant shift in how investors are weighing lagging economic data against the immediate reality of a physical supply crisis.
Equities closed lower for a second straight session.
But the real story was the exhaustion in the narrative. While the S&P 500 and Nasdaq both slipped more than 0.5%.
The selling felt less like a panic and more like a weary acceptance of a high-cost environment in the bond market.
The 10-year yield pushed higher toward 4.3%,
effectively pricing out any hope for near-term rate cuts.
Meanwhile, crude oil continued its climb, gaining another 2% as the shipping freeze in the Middle East shows no signs of thawing. The US dollar remains the primary vacuum for global liquidity,
staying exceptionally strong as other asset classes struggle for footing. What fundamentally changed today was the market's relationship with inflation data. We saw the core PC index match expectations exactly at 3.1%.
In a normal environment, meeting the forecast might provide a sigh of relief. Today, however, investors treated it as a confirmation of a high floor. The realization is sinking in that inflation was already sticky at 3% before the current energy shock.
Investors are now questioning the Fed's ability to pivot, as the higher-for-longer regime is being validated by data that doesn't even account for the recent spike in oil.
Furthermore, with only 77 ships crossing the Strait of Hormuz this month compared to over 1,200 last year,
the market is finally accepting that naval escorts aren't coming to save the day anytime soon. Institutional money is now aggressively hunkered down.
We saw a definitive flow into defensive staples and utilities sectors where investors can hide in dividends and essential services. On the flip side, we saw an abandonment of materials and technology. The software sector is particularly fragile right now. The leadership vacuum at Adobe has triggered a broader de-risking in the space. Interestingly, we are seeing gold being sold to cover margin calls, while Bitcoin managed a 1.5% gain, suggesting it's being used as an alternative
liquidity sponge for those moving away from
traditional institutional leverage. The primary
hidden fragility right now is the
liquidity yield trap, as the 10-year yield breaks toward 4.3% alongside a surging dollar. Global debt becomes exponentially more expensive to service. An interesting debate in markets right now is whether we are approaching a liquidity threshold where even
safe havens start to fail because the cost of cash is
simply too high. I'd be curious to hear how you see this developing. Do
you think the current strength in the dollar is a sign of resilience, or is it a warning of a coming liquidity squeeze?
Feel free to share your view in the comments. The broader macro signal is that we've moved into a confirmed stagflationary regime. The days of bad economic news is good for stocks are over. Today, bad news is simply bad news because the Fed cannot cut rates to save growth while they are fighting a supply-side energy shock they don't control. We are seeing a transition from bits to atoms where physical reality is finally being valued more than digital abstraction. All eyes now turn to the FOMC meeting next week. This is the ultimate confidence breaker. Investors will be scrutinizing the dot plot to see if the Fed officially removes rate cuts from the 2026 calendar. Beyond the Fed,
we are watching for any physical movement in the Strait of Hormuz. A breach of $100 oil is the psychological trigger that could turn this orderly retreat into a much broader liquidation.
The broader takeaway from today's market reaction is that the relief rally of early March has been replaced by atoms over bits regime. Investors are prioritizing physical reality energy, utilities,
and cash over high multiple software and digital growth. But markets rarely move on a single narrative.
So I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today.
I appreciate you being part of the channel.